Hello everyone, welcome to Blue Dragon Actuarial. So today we are going to talk about the second part of the curious case of discount rate. So if you are watching this video, you have to watch the first part in my channel. You can Google for the curious, not Google. You can come to my channel and search for the YouTube videos related to the curious of discount rate part one. So just a brief summary of what we have kind of understood in part one. So part one was in relation to IFRS 4 or Solvency 1, where we have seen that the discount rate has to be at least equal or lower or equal to the investment return. So basically, in that case, whatever you are like, you have a portfolio or you have a block, say a term block or a whole life block, and for those block you are investing in certain asset, which would be obviously it would be bonds, corporate bonds or government bonds, and they are producing some yields, right? Now that is your investment return. So your discount rate, because you are kind of consisting of the, or because you are kind of incorporating the prudence principle, so your discount rate would has to be lower than that, because your discount rate low because your when you are discounting, it's in the denominator. When it is lower, that means the liability would be higher, the reserve would be higher, right? So discount rate has to be lower, or it can at max it can be equal. So that means your discount rate directly depends on the yields that is generated by asset. So there is a direct connection between the yields that is generated by the asset and the discount rate that is used for discounting, right? And obviously we know that in life insurance, like time and again I have told that in life insurance there is no such thing as liability. Like there is no physical existence of liability in a different company. Say for example, in a chocolate company, there would be liability would be the inventory, right? I mean, those chocolates that are not sold, those are liabilities. There is a physical existence of liability, but in life insurance there is no such physical existence. It's you are kind of just predicting based on some mathematical model that this can be my liability for this year, right? So there is no physical existence of liability. Liability is basically our reserve which you are calculating. If you have used profit, it is called mathematical reserve in profit, right? The word mathematical is important there because there is no physical existence of liability. Now that was that situation, and that was the brief summary. But my question there in discount rate part one was, what would happen if the liability is market consistent, right? So there it was solvency one, there the liability was not market consistent. In this case, the liability is market consistent. So what happens when liability is market consistent? Once again, I have discussed this in other video, but just for clarity and for completeness, when your liability is market consistent, it means that had your liability been traded in stock market or any other market, like where there are willing counterparties and they are being exchanged freely between those counterparties or traded freely between those counterparties, then there will be a price, right? So your liability would be treated as a security. As for example, suppose you are purchasing share of a company, like our famous Axis Bank example. Suppose you are purchasing the share of Axis Bank. It can be traded at a certain price, right? Right now, I think the price would be around 800 rupees. So someone will pay you 800 rupees if you have a share of Axis Bank, and you will give that person that share. So similarly, the share in this case is a security, right? It's a kind of an instrument. It's a security. So in similar way, in market consistent valuation, liability will be treated as a security. So what would happen if the liability would be traded in, say, stock market, right? But actually, we know that there is no such liability that can be traded in stock market. At least in Indian scenario, it's impossible. So how would you kind of determine the value of the liability? So the first case is obviously if you can determine the value of the liability, if the cash flows will be replicated by asset, as for example, this hedgeable, like if it is hedgeable, right? If the cash flows of a liability can be replicated by an asset, then it would be exactly the market value of that asset by the principle of financial arbitrage, because principle of financial arbitrage state that if the cash flows of two securities are same, then their price cannot be different, because otherwise there will be arbitrage opportunity. One will short one asset, and another person will buy that asset. This will happen until unless the price of both these two come together, right? So if it is possible that the liability cash flows are replicated exactly by asset or a multiple combination of asset, then the market price of those asset or assets would be the market value of the liabilities. In that, so in this way, it is very easy to understand. That is why it is called market consistent valuation, right? The other would be if it is non-hedgeable, as for example, most liability is. In case it is non-hedgeable, then we need to project it, right? We need to project it using best estimate assumption, because in market consistent we want to calculate the best estimate value. And when we are calculating the best estimate value, we are discounting it at risk-free rate. You can see it is written here, right? You are discounting it at risk-free rate. Risk-free rate means the government 10-year treasury yield or something like that. I mean, whatever is kind of backed by the government, because that is the government can print money to give you return or give you a coupon payment, right? So there is almost no risk until unless the government goes bankrupt, which we have seen. Like there are multiple countries which have gone bankrupt. One of the example would be Greece, gone bankrupt, right? At this current situation, Ukraine, because of the Russia war situation, Ukraine may have gone bankrupt, right? And there are several European countries which are facing gas crisis and inflation. Many European countries may go bankrupt now. US is in recession, so overall world economy is not in good shape. But I mean, if you are considering a normal economy, then government treasury yields are quite secure, and that's why these are called risk-free rate, right? So you project the cash flows based on best estimate of mortality, expense, lapse, etc., and then you discount it back using the discounting rate, and that would give you the best estimate liability. So it would be all that is the other definition, or the second definition of market consistent liability, which where the cash flows are non-hedgeable. So here in this case, you see that there is no direct relation between the investment income that is generated by the asset and the liability. In the previous case, the yields that is generated by the asset are kind of used to discount. But in this case, there is no such concept. The asset are kind of treated separately and the liabilities are treated separately. So in market consistent valuation, asset and liabilities are kind of distinct. They do not depend on each other. That liability would be kind of treated as a security. What would happen if it is traded separately in the market? And assets obviously are traded separately in the market. Their values can be determined easily. So those are kind of like both are kind of not interlinked, and they are kind of distinct, unlike solvency one. Now, because I usually personally I believe that asset and liability should not be distinct, because they should be like the previous method makes more logical sense to me. But the world is moving towards this method where asset and liability is distinct. And because asset and liability is more distinct, one thing takes more prominence, that is asset liability management. So as you are moving towards market consistent valuation, asset liability management would be more important as compared to previous structure where the asset and liability is kind of interlinked. So the yields that is produced by the asset would be used for discounting the liability. So if the yields is lower, then obviously the discounting rate would be kind of in that case the discounting rate would be lower, right? And if the yields is higher, the discounting rate would be higher. So in that case, the movement would be kind of synchronized, right? If the yield is lower, then you expect your liability to go up, which is normal to kind of expect because you are generating less income, right? So that's why your liability should go up. But in this case, reverse might happen. Like yield is going down, but your liability somehow is going up, because both are distinct, right? Both are distinct, although it would not make any logical sense, but because both are distinct, it can happen. So in this case, the discounting is at risk period. Now, why risk period? Because it is dependent on market consistent or risk neutral valuation. So what is risk neutral valuation? Once again, there is a 5-minute video on that, but just for the completeness sake, risk neutral valuation means you are starting from future date and you are trying to determine the market value or price at today's date. So there might be n number of scenarios in which you are which you are using for discounting. Maybe 5%, 5%, 5%, one scenario, 4%, 4%, 4%, one scenario, right? In this way, you will arrive at price for each of these scenarios by discounting. Say the future price is 10 years down the line, the future price is 100, and you are discounting it by 5%, 5%, 5%, 10 times, and you are arriving at a price. Then 4%, 4%, 4%, you are arriving at a price. The ability or the importance of market consistent or risk neutral scenario valuation is that overall, whatever may be the price in the future, your price that would come right now, that has to be the price that is kind of traded in the market. So just to make it more simpler for in our Axis Bank example, right now the price is 800. Maybe 10 years down the line, the price might be 3000 rupees, right? So you have to discount it in some manner so that the average of all those scenarios would come out to be exactly 800. Otherwise, it's not risk neutral. So that's why it is called risk neutral, because no matter what risk you take, ultimately the price has to be today's price, right? So there can be 10,000 scenarios of different rates, there can be 20,000 scenarios or 1 lakh scenarios of different rate, but in whatever manner it would be discounted, the price has to be today's price, which is the market price, right? So risk neutral valuation is looking backward, and that's why risk free rate is used in this case. That whatever number of scenarios you used, ultimately market consistent valuation or risk neutral valuation or fair valuation, that would mean both the same kind of, all these are kind of meaning the same thing. That would mean that the price that you would obtain would be the market value of the price, would be the fair value of the market value, and that's why risk free rate is used. However, there are a couple of adjustments that you can do, and that depends on the block of business. So for example, if you are selling annuity products, so in annuity product, there is no surrender value usually, and because there is no surrender value, so in that case there is something where we can use the matching adjustment. So that happens because you are, suppose you are for annuity product, there is no surrender, so there is no partial payment that you have to make in between the term. And suppose it is for 10 years, then if you are holding a corporate bond, even for 10 years, corporate bond will obviously give high yield as compared to government bond. Because you are holding corporate bond, there might be a lot of volatility, but you did not need to sell the corporate bonds, right? Because uh, there is no surrender value. So that's why you get additional advantage. So that what that would mean is that your discount rate can be increased. Discount rate increasing means your liability will be decreasing, because discount rate, as I mentioned before, is in the denominator. So that's why your denominator increases, your liability decreases. So matching adjustment can be applied. Then there is something called volatility adjustment, which can be applied by insurance company. Matching adjustment is only applicable for annuity business. Volatility adjustment can be applicable when the market is too volatile, because if the institution sell, then the market will become even more volatile. So you can apply some volatility adjustment so that you can sell at a better price when the market recovers. So applying using that volatility adjustment means that you can increase your discounting, and once again the liability should be smaller. Otherwise, because of just that random knee-jerk fluctuation, your liability would be a lot higher, and that will also send the market into frenzy, because institutions are usually the big players, right? So there are multiple adjustments that you can use over and above the risk-free rate, which would be matching adjustment and volatility adjustment, etc. Right. So I think the idea of market consistent valuation, risk neutral valuation, and what would happen in market consistent valuation, how the discount rate would be calculated. In this case, it is a risk-free rate, right? A risk-free rate plus some adjustment usually, and there is no relation between asset and liability. So that brings us to the end of part 2. The part 3 would be dependent on what is the how would the investment income, or in this case yield, react or be uh, I mean, would react in the embedded value scenario when you are using the market consistent discount rate. So what will be the relation between the discount rate, in this case the risk rate, and the investment yield, and how would the embedded value be calculated? So that would be the part 3. And I think based on what we have discussed till now, you can actually arrive at the answer. So if you have the answer, please write it in the YouTube comment section, and it can be right or wrong, doesn't matter, but I mean, I can use those comments to kind of build my part 3 video. So thanks for watching this video. If you like the contents of this channel, please please subscribe and share with your friends. And I am closer to the 500 subscriber mark, and I have some plans for some giveaways. So I'll be giving you some t-shirt, but there will be a competition for that, and only the top 10 people would be getting that. So I'll be making an announcement about that shortly. So stay tuned for that. Until then, please watch my video. Happy learning, and like the video if you enjoy the content. Thanks for watching, and see you in future videos.